Welcome back. We are talking asset allocation today, and with us is Kenneth Minjire, who's the head of Securities at Genghis Capital. Kenneth, welcome.
Thank you.
This is probably your first time to be on Metropole TV.
Yes, true.
Yeah, we look forward to hosting you more in the future, actually. But Ken, we are talking asset allocation. First half of the year, there was a lot of risk aversion, heavy allocation towards fixed income. And my biggest question is, with such a risk aversion, high levels of risk aversion in the market, how do you deliver alpha for your clients? I mean, is it really possible? I mean, the yield curve is softening on the longer end. It's just a question of how do you deliver alpha in such an environment?
Thanks, George. Basically, I wouldn't call it risk aversion. I think it's just hunger for returns.
Yeah.
When you look at traditional asset classes in our market that asset managers will invest in.
Yeah.
And remembering that most asset managers, majority, the larger percentage of their AUM is made up of pensions who are already quite risk averse.
Yeah.
But you're looking for return, you're hungry. And when you look at equities last year, single digit return.
Yeah. Even this year, we're set for.
Yes. Look at real estate, same thing. And of course, when you're doing your asset allocation, on average, most IPSs will allocate about 50% to fixed income. Of course, you can move within a certain band.
Yeah.
But last year saw fixed income had a double-digit return. Of course, this has been driven mostly by the interest rate cap.
Yeah.
And banks not having much of a choice in terms of where to put their money in, as well as because of the cap being at 14%.
Yeah.
You're sure of the level that the rates can only, even if they do turn up, the level they can get to. So there's been a lot of money chasing very little in terms of securities and assets.
Even the market has been very liquid this year. I mean, look at auctions.
Extremely liquid. If you look at the auctions, I think this year is when we hit 100 billion in subscriptions. That's the first time that has ever happened.
Wow. 100
Yeah.
billion shillings.
Yes, for a subscription for 2 year. The offer amount was about 40 billion.
Yeah.
We got about 100 billion in subscriptions.
Wow. Where's this money coming from?
They're not lending, and we've been singing the same song over the last I think 24 months.
Yeah.
So if you're not lending and you need to give your depositors your return, you have no option but to put your money into the fixed income market.
So is it the banks or is it the pension funds that have the liquidity?
It's actually across board. I'd say, of course, majority of it's from the banks who are not lending, but pension funds as well have moved quite a chunk of the funds away from the equity market into the fixed income market. So a lot of them right now, on average, you're looking at allocations of between 50 to about 65%.
All right.
Which makes sense in terms if you're looking for return and basically you're risk averse. And also, I'll say there's been an apathy nationally, both pensions, retail investors, high net worth investors to the equity market. We've seen the cycles, we've seen the return. The number of investable stocks has come off to roughly about 4 or 5 stocks in the market. And the cycles are actually when you sit down and look at it, you're talking about 3 stocks, maybe 2 banks and 1 telco, Safaricom. So the options are very limited.
Yeah, that's true.
Yeah.
And so I'd say I'm neutral on the equities market. Maybe I'm a bit medium on FI, but I don't expect double-digit growth this year. I'm looking at probably upper nines, most likely.
Yeah.
But then on FI, is it longer end of the curve, shorter end of the curve?
Of course, because of the way the bond mechanics, and rates have been consistently coming off from the beginning of the year, you'll definitely make a better return when you invested in the longer end of the curve. But also you have to look at the kind of investor you are. So for example, you'll find with banks who are trying more or less to match their liabilities. On average, liabilities in Kenyan banks range to about a maximum about 5 years.
Yeah.
So even the asset classes, the securities or the bonds they'll invest in are range between 5 to a maximum of about 10 years. They would love to put in their money to 15 years, which makes more sense because of convexity. I mean, a 10 basis point drop in a 20-year paper and a 2-year paper, the returns on the longer end will be a lot healthier.
Yeah, that makes,
but they're limited
Yeah.
because of their own internal risk guidelines
yeah,
and matrices.
and liquidity guidelines, because
Exactly.
sometimes you have to match fund your license and liability, as you say.
Exactly.
But Ken, you talk about diversity. We're going live on derivatives this week, and it's
Tomorrow, actually.
It's tomorrow, right?
Yes, it is.
So they're
Soft
calling it
launch.
what? It's a soft launch.
It's a soft launch. The official launch is on 11th.
This is next week. This is a new asset class coming to the market. I mean, as an asset allocator, I mean, or someone who has a visibility on asset allocation, is this something you're bullish on? Are you going to rack up more derivative positions? To
be honest,
yeah.
I'll go back to, it depends on the kind of client I'm investing on behalf of,
yeah.
or you as an investor, what the kind
Let's
of
talk
investor
unit
you
trust.
are. Unit trusts, no, I highly doubt unit trusts will be going into derivatives, not just yet anyway.
Yeah.
And traditionally, a lot of the asset managers, as I said, are quite risk averse. And they'll have to deal with, of course, they'll have to be restructure their IPSs. So, for example, for unit trust, we're only talking probably equity funds and balance funds.
Yeah.
Money
Okay.
market funds can't touch derivatives markets.
Okay.
Those two funds make up a very small percentage of the total AUM of the unit trust market in Kenya at the moment. They have consistently been shrinking over the last, I'd say, about 6-7 years.
Why are they shrinking?
Same thing, equity market performance.
Okay.
If you track, you'll just find they'll track equity market performance.
Exactly, okay.
And also the apathy that investors have had towards the equity market has translated the same thing into balance in equity funds. Because when you're consistently making losses, you don't want to touch. You've burnt your fingers. You'd rather stay in a money market fund where your capital is, your principal is secured.
Yeah.
So yes, the most likely candidates would be, of course, maybe the equity funds.
Yeah.
For those who have a bit of risk appetite.
That can be aggressive a bit.
Yeah, which are few and far between.
Yeah.
So I don't expect an immediate takeoff.
Yeah.
But I believe it's a brilliant move for the exchange.
Yeah, in terms of diversity. of
Yes, in
products.
terms of, because clients, I mean, investors have been calling out for new products.
Yeah.
There's been the GEMS market, which was launched, not very successful.
Yeah. Now we have Ibuka.
Yeah, we have Ibuka, we'll see.
But the
Ibuka.
interesting names on Ibuka, so Tuskys, would that be something that's palatable and at least is able to gain traction for the equity market?
I think the FMCG market, a lot of investors, especially even offshore and even local, have been wanting exposure to the Kenyan FMCG market.
Okay.
For the longest, from I think, but I'd say maybe for 2010, we've seen the growth in consumption.
Yeah.
It's just slowed down within the last 24 months because of course, the rate cap bill.
Yeah.
Okay.
But FMCG market has been the fastest growing market in Kenya. That's why we are a flood with supermarkets.
Yeah. But it's very simple, Ken. I mean, people have to eat.
Yes, they do.
Yeah.
Definitely.
Even if there's an economic downturn, people still have to eat.
Yes. And of course, with the path we had before, the rate cap bill and standards of living rising, and I put it in quotes, the middle class getting more purchasing power. The marginal middle class. Getting more middle class.
Yeah.
The last 24 months have been quite hectic for that.
Ken, let's talk risk aversion. You talk about trustees and asset allocators. How much of risk aversion is driven by trustees today? Is it driven by both the two sets of parties, or it's more heavily biased towards trustees?
I'd say, first of all, actually, you've hit on where I personally believe lies one of the biggest problems with our pension industry.
Yeah.
And basically how it's managed. We have asset managers who know what they're doing, who understand the markets, who understand the cycles. Yeah. And then on the other hand, you have trustees, and you have archaic IPSs and reporting schedules. Quarterly. It makes absolutely no sense on why a pension funds are long-term investments, basically. Yeah. These are long-term assets for pensioners. On average, what you're talking 60, 70 years? 60s, yeah. Why would I be reporting every quarter?
For 25 years.
This is long-term money we're talking about. Yes. It makes absolutely no sense. What kind of investment strategy would you be able to apply over a 3-month period and then bring back return.
Yeah, that's
still
very
makes
very
sense.
because we've had people sitting on that chair and talk about trustees. Maybe you remember we've had CIO of Mana Capital talking
Yes.
about really castigating this quarterly reporting.
It's absolutely makes absolutely no
It's
sense
rigorous,
for long-term
yeah.
funds. It's vigorous, and also another
But
aspect
who
of
can
this
change
is,
it? Is it the trustees? It
No,
looks like it's the
this-
regulator.
I believe this falls with basically RBA has to lead the charge on this.
But who sits on the RBA board?
Of course, it's pensioners. I mean, they're different-
trustees.
and trustees.
Okay.
I can't put it squarely on RBA,
Oh,
but they
right.
do have to lead the charge on this.
Yeah.
Exactly.
Another aspect that is also not talked about quite a bit is basically, I'll just put it out there, the financial literacy of a lot of these trustees.
Yeah,
So
yeah.
a lot of
Yes.
a lot of training and basically financial training, financial
Yeah,
education
yeah.
needs to be done.
Yeah.
The caliber of trustees we have in this country needs to rise.
Yes.
With a lot of the new funds, we've been seeing it happening. I don't want to mention names here, but there's quite some impressive pensions that and very large for some parastatals which are very forward-looking.
Yeah.
Who also run, you'll
Very
find they also
progressive.
run their own investment committees within
Yeah.
the organization that look at what their pensions are doing.
Very
and they're very,
impressive.
very progressive. And if you try compare their 5-year return compared to some of the traditional ones, I mean, they're nowhere in the, I mean, you can't even compare them.
Yeah.
So we have seen the caliber of some of even the newer pension schemes from these companies. The trustees are younger,
Yeah.
understand the markets a bit more.
Yeah.
So of course they'll have a slightly higher risk appetite as well.
Okay.
Yeah. We've had two themes come out of trustees, and we've had a number of people talk about this issue. One is that corporate trustees, the market needs to probably embrace corporate trustees who are a bit more switched on, more progressive, understand these asset classes, can even challenge the asset allocator, the asset manager. And also that's one. Number two is that we've also had a situation where asset managers need to profile pensioners. So you have people, let's say, below 35 years old, you have people below 50 years old. So if you have people, typically if you have people below 40 years old, you have about 20 years to deliver some return. So that portfolio, you need to have a portfolio categorized by age profile. So if a portfolio for people below 40 years, you probably need to be more aggressive.
Yes.
Buy some more, not toxic, but some very complicated instruments which can give you more returns.
Yes.
Probably invest in like PPP, participate in PPP projects which could deliver you something like 20%. But then you have a portfolio where, let's say, people above 50. Then that portfolio you probably have
you
to be
become
very
Exactly.
defensive. Capital preservation being at the heart of your asset allocation. Do you share those sentiments?
I believe, of course, basically if you have people who are expecting to come looking for the money in the next couple of years, 5 years, 10 years.
No, that's a bit.
Yes, you could, there's some risks you cannot afford to take.
Yeah.
And it's true, capital preservation should be the core of your investment strategy.
Yeah.
But if it's a much younger
Like me.
category of pensioners, yes, like you,
Yeah.
like me, although George, I'm not very sure you fall into that. So of course,
very young.
it gives you flexibility to try out a bit more. I won't use the word used. Toxic, no. A bit more exotic,
Yeah.
exotic
high yielding.
asset classes.
High
which are
yielding
high
assets.
yielding
High
assets.
Would
yes.
rates fall in that category? Because when you're talking about alternative investments on the NSE, so we have derivatives that might not get local market traction. What about rates? Because rates are there. We're talking about the gold ETF. So there have been new opportunities there that could potentially give you upside. Why is it that the local fund managers don't want to participate?
I'll say on REITs, basically whatever REITs we have listed, of course, do not honestly give you confidence, especially when you look at the underlying assets.
Yeah.
For the gold ETF, I think it's a brilliant, especially if you look at the rally we've had in gold over the last couple of weeks.
Yeah.
Okay.
That would have been a brilliant opportunity. So I'll just put it back again to risk aversion, not even driven by the asset manager themselves, just driven by the reporting standards, what's expected of them from the trustees.
Wow.
So of course, first of all, getting leeway to invest in the gold ETF. That's a very long journey. Sitting on the trustees, taking it through them, they have to decide. I mean, as I mentioned, we still have trustees who believe in brick and mortar.
Wow.
And this is a government security.
Yeah.
Okay, good stuff. This I understand.
So then are you saying that the issuer not only needs to have roadshows with the fund managers, which is
Yes.
typically what happens, they probably need to start marketing a year in advance and start trying to get to the underlying, the trustees.
They need, that's the key right there. They
Which
need
means
to
maybe
talk
they need 2 years before you can actually introduce a new product.
Yes, you need to speak. And I was actually going to mention that when we talked about derivatives.
Yes.
As I mentioned, we've had quite a number of new products over the last, I think, 18 months. More so since the leadership at the helm of the NSE changed. We have an aggressive CEO there. But the take-up from the market has been very poor.
Uptake is very poor. Yeah, I agree.
We've seen that.
Exactly.
And I believe it comes more from a perspective of marketing and investor education.
Okay.
And not educating the right people. So you launch a product, no one knows it. I mean, just walk out on the street right now and ask someone about the gems market. I mean, most even, no idea.
Yeah.
Ask them about treats.
Ask them about Ibuka.
Even Emma Kiba. So it's like you see a lot of marketing and this is what we are doing, but then the user doesn't know, how do I access, what do I do, who do I speak to, how do I resolve any issues when I'm making this investment. That's a very good point.
They mentioned about Emma Kiba. I actually want to ask you, what do you think they're getting wrong? What are they getting wrong? I mean, you're a veteran of fixed income market. What are they getting wrong on Emma Kiba? And is it a brilliant idea?
Yes, Emma Kiba is a brilliant idea. I'd say on Emma Kiba 1, what they mentioned.
Yeah.
In terms of the marketing, it's not targeted, and I mean, the marketing campaign on that needs to change.
Yeah.
But also over and above that, there's some inherent issues. For example, Kenyans do not traditionally have a savings culture.
Yeah.
So as opposed
to
low
savings rate.
Yeah.
It just feels nice to be able to consume, because you've not been consuming for a very long time.
Yes, it's just started.
You've just started, so you're just like, oh my gosh, you must get everything anyway. That's on a light note.
So so if you find, like, for example, you can't compare the kind of penetration we've seen from mobile lending apps.
Yeah.
And mobile savings apps.
Yeah.
Exactly.
I mean, in terms of mobile lending apps, I mean, it's crazy. Everyone in the world wants to come and open a mobile lending app in Kenya.
Can we have 52 mobile lending apps?
Imagine.
52.
It's
more than the banks.
It's ridiculous. More than the banks.
It's more than the banks.
And they're all doing business.
Yeah.
And profitable business.
Of course, because some of them, when you calculate, they're charging upwards of 50%, 60, 70%.
Yeah.
But remember, that's lending.
I have Tala by there, I'm not to admit.
Yes. So that's lending.
Yeah.
Now come this other end, and you're talking about savings. So Kenya does not have a savings culture, which is what also at the end of the day also needs to be fostered. I think also another aspect of it is the quantities that you can invest. Because yes, it's meant for Wanjiko, the lady who has a grocery shop, small amounts.
Yeah.
But at the same time, there's quite a number of high net worth clients who'd love to put their money in Emma Kiba.
Yeah.
I honestly believe, with this one, of course, they increased the amount that now you can use PesaLink.
Yeah.
I think 999,000 being the maximum amount. But I believe,
Okay.
So if they were able to increase that amount to a one-off buy, I think they'd see a lot more participation, especially from high net worth clients. Me as a high net worth, I don't think I'll sit down and put 999 today, 999 tomorrow. It's quite tedious.
Yeah.
Which is also what they faced during the first one. I think the maximum was about 140,000. But investor education is the key. Targeted marketing, and also now basically as just a whole drive, just driving a savings culture within the country.
Market.
But on the savings culture, when you look at our national savings, it's about 11%. And our debt rate, I mean, we really can't get into that conversation of debt. But at times I tend to compare that 11% at a national level to some of the Asian tigers that we keep saying we want to look at.
Yeah.
If you look at Korea, for instance, their savings rate at a national level is 36%. So, you're like, okay, as much as we keep talking and saying this, it takes you 7 years to change our culture.
Yeah.
So then are we saying maybe for the next 7 years, we just keep consuming, keep investing in these lenders, digital lenders, because how do you then move from we are not saving, we are consuming, but we need to save. If at a national level the government is not taking that responsibility, how do individuals then begin to take that responsibility?
But can a very important, I also want to add the question is the low savings rate, is it a function of low wages in the economy? You think it's?
No, technically no. When you think about it, because the low savings rate, of course the standards of living does come into it.
Yeah.
Okay.
But of course when you look at the wages, you'd still be able to save in terms of it's not directly correlated to the cash money. It's just the amount of savings.
Yeah.
How much are people saving of their income against their income?
Yeah.
So the low wages are taken into consideration.
Yeah.
And there's something you've mentioned about the Asian tigers I wanted to touch on. You also have to remember as an economy where we are. And so it's a very thin balance. The government has to balance between encouraging consumption to grow GDP.
Yeah. Can I have to cut you short, sorry.
Yeah.
And for the very one simple reason is the market is open. We need to ring a bell.
Oh.
Yeah. Let's ring the bell. Come back shortly. Welcome back. We are talking asset allocation, risk aversion, trustees, corporate trustees, and with us here is Ken Minjire. Ken is also a veteran of the fixed income market, he knows a lot. Ken, talking about fixed income market, talking about risk aversion, money market funds, some of them delivering north of 12%. How do you look at them? Is it the best way to judge them? Is it justified? Should I be scared at a money market fund delivering 13%? In an environment where 91-day T-bill is just about 6.5%.
No, not necessarily. I think, of course, it's always good to do your due diligence before putting your money in any of the funds. And I won't speak to whatever assets they're holding. But I will say this, yes, as you mentioned, for example, where the 91-day T-bill is, the 1-year T-bill is below 9%, 8.74. So basically, I would assume that some of them are still holding older securities.
Yeah, like Nakumatt CP.
No, not Nakumatt CP, like older T-bills, when some of the T-bills
yielding
were
11%.
Yes, 11 and 12%. Okay. Of course, for maybe the ones who have a bit more risk appetite, they may be putting some of the money into CPs. And there are actually quite some good CPs out there in the market that are yielding 15, 16%.
Yeah, Branch is selling a CP at 18% now.
Yes,
local
Branch,
currency, which is good.
Yeah, Branch, for example.
Who's marketing that?
I think it's Center marketing it, yeah.
So there are some good CPs out there.
Okay.
Musoni, for example, we are doing Musoni.
Yeah.
What are the returns on that?
With 15 and 16%.
Oh, wow.
That's a CP?
Yeah, that's a CP.
Oh, that's
Is it still
15
open?
to 16.
That sounds very interesting.
We're about to open for our second tranche now. We closed
that's the second tranche. You closed the first tranche.
First tranche was oversubscribed.
See what return does? It just engages everybody.
Yes, and it was actually, and funny enough, the aversion from the local market, the market was really averse because we did roadshows, fund managers, high net worth clients.
For Musoni, is it open to high net worth retail, or is it?
Yes.
What's the minimum ticket size?
We didn't have a minimum ticket size.
You put any?
We were looking about 10 million on average. It wasn't very large, but
so with $1 million, could somebody put in 100,000?
Yes, you could put probably $1 million being the smallest ticket size.
Okay.
Yeah. But I'll surprise you that
it's high net worth.
Big ticket.
So he doesn't want. Okay, maybe he can take you. So I probably may not make the cut. One day.
Oh, really?
One day, Minjire. One day I will be there.
But I'll surprise you. 80% of the investors in Musoni were offshore, not local.
Oh, wow.
So it just shows you the
Why?
version.
What was the sentiment?
Just basically, of course, when we did it, it was just right after some of the issues we'd had with, for example, Kaluworks.
Okay.
So there was still a lot of aversion and apathy towards corporate papers. But I think we may see better take-up after in the second tranche because it is guaranteed. Okay. If you want fully guaranteed, partial guarantee, it also determines the kind of return we can give you on that CP. So yes, some of the money market funds are holding.
So it's just
good credible CPs.
It could be legacy assets.
Legacy assets as well as even current. Because currently for you to get double digit north of 12, 13, I'd say is you can't do it from deposits, you can't do it from papers that have a maximum duration of 1 year. So CPs is the way to go, but of course you have to do your due diligence and just know that the company that you're investing in.
Yeah.
Just once, if I can circle back on the CP market.
Yeah.
So are we seeing investors demanding higher returns?
Of course,
Yes.
the premiums are quite high. I mean, if you're looking at, I mean, when we were doing the roadshow, some investors were demanding as high as 18-19%.
Oh wow, that's pretty steep.
It's quite aggressive. Right?
Yeah,
Yes.
Traditionally the premium has always been about 200 to 300 basis points above market,
the market.
The government rate. But of course,
What's
after
the
all
reference point? The 1 year or
depending
5 year?
depending on
the tenor?
the tenor of the
Okay.
CP. So, but of course, after all the corporate governance issues we had with previously issued CPs, the premiums, the risk premium they were asking
The
for
bands of did widen.
Wow.
I mean,
widened.
you're talking about 600
dramatically.
basis points,
700
yeah,
basis
crazy.
points.
But
So
Ken, as a veteran of FI market, how do we? I have to ask a question which I normally ask every fixed income participant here: is how do we get the corporate market back?
I think it's just basically building confidence in investors.
Yeah.
We went through a painful period, both I think in the fixed income and equity market,
Yeah.
with a lot of the listed counters facing corporate governance issues, which has been one of the weaknesses we've had. What I say is when the wind blows, even turkeys fly.
Yeah.
And that's where we were for.
Yes.
That's where we were for many years.
Yeah.
Because the wind was blowing. I mean,
And every turkey was flying.
all the turkeys were flying. No one would recognize any of the problems. Everyone was
That's
busy
nice,
expanding, posting brilliant numbers, results. But as soon as the wind stopped blowing,
Yeah. All the
the
turkeys.
cracks started showing up.
Yeah.
And so, on one end, what comes out of this as a positive
Yeah.
is we will have a cleaner market, cleaner listings.
Yeah.
Of course, the regulator as well has really clamped down, because even they fell short
Yeah.
by apparently doing due diligence, and on the day of issue,
Yeah.
a whole
Is
corporate
it?
paper. I
On
mean,
the
is
day of issue?
on the day of issue,
That doesn't even
a
make-
bank goes into receivership.
Yeah, I know that. I remember that.
So,
remember that.
I mean,
Yeah.
such cases
Yeah.
have really shaken investor confidence.
Yeah.
But what I believe from this, the positivity, of course, I mean, with a lot of new legislation going through and
Yeah.
regulations from the regulator,
Yeah.
they've also tightened their own ship.
Yeah.
Okay.
And even the exchange itself
Yes.
as well.
From your roadshow, did you come across investors constantly asking for credit enhancements?
Of course, that's
Yeah.
what I say. That's why one of the biggest advantages we had was our papers got partially guaranteed.
Yeah.
So
Who offers these guarantees?
the different, I think none within Kenya that I can think
Okay,
of,
all right.
but there are different, even banks, even FDB, for
Okay,
example.
all right.
There's some insurance companies that offer the guarantees. So there are different places with
premium,
the
of
guarantees.
course.
Yes,
Okay,
at a premium, but not so excessive.
Yeah. Did it rest the whole issue cost?
Yes, it
When you
did,
bring on board
definitely.
enhancements?
Yes,
Okay.
definitely does.
Material increment, or is it something that's worth?
Yes, it is actually worth it at the end of the
Okay.
I think some of them charge about 300 basis points, which add to your
Ooh, that
statutory
was
It wasn't
fees.
300, but
Okay.
Right.
I'm just okay.
Oh wow, very interesting.
Yeah.
I wanted us to circle back on the element of
The Asian tigers.
Asian tigers,
Yeah.
just briefly, because when we keep talking about the economy today and you're talking about the NSC, you're only left with 4 counters that you can possibly get a return from. And then we're also seeing the yields are coming back down on government bond papers. If the rate cap doesn't happen, what does Kenya need to do? Because we're in a space where we are saving much less. We're at 11%. The bulk of our expenditure is going into recurrent expenditure. Very small chunk of that is going into development expenditure, and there's no money that's circulating in the economy. So broadly, then where do you begin to invest? If you're not going to invest in the CPs, and we've only mentioned 2, then where do you begin to put your money to grow if the economy is not growing? What could spur it, referencing from the Asian tigers?
If the rate cap remains as is, but which I doubt though, of course, because we've seen the effects and everyone is on board, I think.
Exactly.
This time
Thank
around.
you for that. I keep having this argument
Can we
with
be taking a
George.
poll?
George says it
People
will not
believe
happen.
that the rate cap will stay.
George says it
so
doesn't
far,
happen. I
the
know.
highest number of people believe that the rate cap will stay as it is.
I don't believe.
No,
Yes.
George,
Not to-
that's a fallacy.
Oh, okay.
George, you don't represent the whole world. So we keep having this
Okay,
back
fine.
and forth.
Yes.
And he says that it won't change. And I keep saying that the last 1 year, there's a lot of legwork that has been done.
Been done,
And I
yes,
think there'll be
true.
an adjustment, even though it's not a total repeal.
Very true. And apart from even the legwork, even the effects on the economy, and now with demonetization in the second half, and adding that onto the rate cap, I mean, it will be impossible. Basically, the economy will grind more or less to a halt. So something does need to be done. I don't believe they'll remove it completely, But just the same way they did an adjustment
the last time,
financial
remove
year.
the floor and the deposit.
They'll just
They'll do an adjustment this year, just basically to take, and that this has been a lot of talk of this during the whole year, just basically to find a way to take into account the risk, so banks are able to price in the risk, not at the ridiculously rates we were seeing previously, but within a certain band, which will allow comfortable band for both consumers and the lenders as well. So yes, I do believe there'll be an adjustment, but in the instance that there's not, I'll be honest, in terms of returns, especially for the second half, we are very limited. Apart from fixed income, which I think I mentioned, I'm medium on. I think definitely out of the investable asset classes, especially for averse investors such as pension funds, fixed income looks the most attractive for the the second half.
Second half of the year.
You may deliver 10%, 9%, but looking at the real estate sector, which continues slowing down every quarter, everyone's hurting on that. We may see some 2 cycles before the end of the year in the equity market. Yes, we only have 4 counters, and to be honest, we're not being driven at all by fundamentals at the moment. The 4 counters are purely driven on technicals and market speculation. So if, of course, for an aggressive manager who is able to follow the cycles, yes, you may be able to post a return within, if you get in at the right time. Within the next cycle. And in fact, I think now is a very good time to buy.
Especially the banks.
Yes, especially the banks. Just to prepare, because there definitely will be a cycle before the end of the year. Offshores are not participating as heavily. Most of them are looking at Zimbabwe, which is doing brilliantly. Nigeria and Ghana.
The sentiment on Zimbabwe, has that changed before the sentiments that were shared by the government on the currency? Or was there
no, even before there was quite a bit of money going into Zim. So the Jimbos are doing quite well. As Nigeria and Ghana. So and we've seen the way the markets have performed well. Even, I mean, look at the GSE as well. NASPA's, they've done quite well. From the beginning of the year,
and especially on the IPO side, they've done very well since the last 1 year. So we have the profitable moment that they have, courtesy of Ken, fixed income looking attractive in the second half of the year, and also buy stocks. You said banks?
The banks.
I think it's the banks. Buy the banks.
We keep saying.
At your own risk.
We keep saying. You know, the thing is, George, you can't. I like what you're saying, and I agree with you, because where we are at, the trigger now is what's going to happen to the rate cap. Unless now something completely, if nothing happens, it remains where it is, which has already been factored into price. But you cannot afford to ignore a sector that's at 1 times book. All the banks that are listed, that's at 18 to 20% ROE.
Are you saying that the market is wrong?
That's at 18 to 20% ROE. You know what? You put your money, because you're saying you're a high net worth, you can afford $1 million. I can afford 100,000. So let's put our money where our mouth is.
I'm going to buy a CP.
You're going to buy a CP. You're a lazy investor. 18%. That's lazy investing, George.
18%.
Lazy investing.
He's
only cost to me, 5 shillings, 5 shillings to call you on Safaricom. Hello, where's the application? And then another 5 shillings on data. Let's see.
Let's talk deficit. You've spent some time looking at the numbers. When you look at the deficit, the quantum, how do you see the interest rates playing out, the domestic interest rates playing out in the current fiscal year? I
think it's also tied in with maybe the rate cap and the level of adjustment that's done to it. It will determine a lot in what will happen with the interest rates going forward. I think, especially when it comes to domestic borrowing, to bridge the deficit, I think we'll be able to meet that comfortably. Over the last 2 years, the CBK has been very successful in raising funds for treasury from the domestic market, of course helped again by the rate cap, which is why it may affect how successful they are this year. But I still believe, because even if the rate cap is adjusted, the amount of money that has been moved from active lending into the fixed income market by banks, it's very, very difficult to basically unbundle and lend out that amount of money in
3 months.
We're looking at probably 18 to 24 months.
Exactly.
So a lot of the money will still be in the fixed income market. So my view on rates, I actually believe especially within the second half, we'll continue to see them trend down as investors continue to chase returns. We've seen, actually, honestly, we've seen investors who before were very risk averse for tenors above 10 years. You're pushed so far into a corner that even within your own internal controls, you adjust your returns. So you're seeing investors who are only doing 10-year notes, 10-year papers now doing 15.
Wow.
Basically looking to chase yield. You're looking at 12% because you can't get 12% on the 10-year paper.
Where were bids? Where did bids average over the last quarter?
Over the last quarter, I'd say
we've below 12.5.
Especially on, for example, the 20-year paper. We're currently below 12.5 already.
For 20 years.
Yeah, and this has been driven, I think, over the last month or so, especially by investors who, you're in a corner, you need to give a return.
Exactly.
You have no choice, so you put your money in the 20-year. And I think there's also a level of comfort that investors have gotten that the rates are not going to take up. So at least we're seeing the market sentiment is not uncertain. They're quite certain on rates. Will stay flat with a bias to move slightly down, especially on the longer end. I doubt we'll see the CBK aggressively issuing short papers. You also remember on their end, they're trying to manage the duration of the maturity risk, which is
actually very high at the moment.
Exactly. So they will be biased towards longer term issues. And we will see a lot more investors begin to put their money in longer term issues and take the trading opportunities. There. So
a lot of fixed income portfolios will be above water in the second half of the year.
Yes, I believe they'll be above water. The return might not be year on year. Of course, the return will be lower than last year, but definitely when you compare with the other traditional asset classes, FI will perform better.
But the best asset class is Musoni at 15%.
Yes, I wish more investors would put in. It's a stable company. They do impact lending. Which is quite attractive, as opposed to where you're charging your clients 100% annualized rate. I mean, what they charge their clients is very fair, and it's also very targeted towards communities where you can help. So it's what do they call them? Social impact companies. It's a social impact company.
And how's the performance? Asset performance is quite good.
Yes, it's quite good, and that's why we're coming back to the market for the second tranche.
And most of the money goes towards on lending.
Yes, towards on lending. Actually, all of it goes towards on lending.
All of it goes on lending.
I've heard of it. I absolutely like what they do. I love the credit and their business model.
All right, we've got to leave it there. Very enriching discussion with Ken Minjire, the head of securities at Genghis Capital. Lots of tidbits. Musoni, 15%. Be the ones to buy that. Fixed income, a good trading strategy for the second half of the year. Equities, looking at the banks. Well, there's a chance, according to Ken, that the cap could actually be raised up a bit. Although, I mean, we have divergent view on this. But you should look forward to more discussions, such like discussions, very innovative, very creative, in our afternoon session. For now, we'll leave you with the market opening figures and see you in the afternoon.